You got to think long term. This is not a get-rich-quick scheme. This is a place that I can put my capital consistently over a long period of time. And the more I put in there, the better it does. But these policies become more efficient with time. You don't have to do anything. Just by the mere existence, these policies get better and better. They become more efficient. As a matter of fact, the most efficient whole life policy structured this way is the oldest policy that you own. We do need to think long term, and we should think long term, but that's not at the sacrifice that I can't have access to my capital today. I can have access to my capital in 30 days, 6 months, 1 year, whatever the case may be. But I'm still thinking long term. I'm going to use my capital. I was going to use it anyway. Now I'm going to solve my own need for finance. The more I use it, the better it gets, because I'm valuing my capital. I'm putting a valuation on my capital, and I'm paying myself the cost of my own capital. That's in addition to the actions of a life insurance policy structured this way. They are very powerful from day one. They get more and more powerful every day, every year they're in existence. So by me using my capital, they're only going to become more efficient and more powerful. Okay, now think about this. I've got a daughter, she's 5. In 50 years, she's going to be middle-aged. I'm going to be dead and gone. I'm not going to be here. The best policy that I have today, the most efficient policy that I have today is her policy. Because in the 50th year or 50 years from now, that policy is going to be much more efficient than any of the policies that I have on my life or my wife's life. Because you have the exponential curve in these life insurance policies. The internal rate of return may be 4 to 6% over a lifetime, but in the first couple of years, there's a net loss. If I put $100,000 in, I'm going to lose access to about 20% of that, or $20,000, whatever it may be. How can I say that if I've had a net loss in the first year or two? How can I say that if the premium that I paid in doesn't equal the cash value until the 5th year? Because in the 50th year of the policy, the internal rate of return is tremendous. But also, most people don't consider that there's an internal rate of return on the cash value, there's an internal rate of return on the death benefit, and there's an internal rate of return on the cash flow. Because if I pay a premium into the policy and I take a loan from the insurance company with that policy as collateral, that is a cash flow. Money flowed in and money flowed out. There is a rate of return on a cash flow with a life insurance policy. And the financial professional hasn't been taught this. He can't teach his clients if he doesn't know. Most, have you ever heard there was an internal rate of return on a cash flow in a life insurance policy? No. There's an internal rate of return on the death benefit, there's an internal rate of return on the cash value, and there's an internal rate of return on the cash flow. That's powerful. And compare that to other assets that have guarantees, because I have ironclad guarantees in a life insurance policy. So if you look at life insurance as an asset class, it's powerful.